As the U.S. markets are closed for the weekend, we are looking at the final closing print for Opendoor Technologies, ticker symbol OPN. On Friday, October 31st, 2025, the stock finished the session at $7.77 per share, concluding a very volatile week that saw the stock jump 5.1% in that final session alone. This stock is a powder keg of investor expectation and harsh underlying reality. The immediate tension everyone is watching is the upcoming third-quarter financial results, scheduled for November 6th. And what's fascinating is how the company is doing it. They just announced a financial open house, a new format to be live-streamed directly on platforms including the Robinhood app and YouTube. This is a brilliant and perhaps desperate public relations move, a direct appeal to the retail investor base that has been a primary driver of this stock's wild ride. It's a signal that they know their audience, but it also creates an immediate conflict. The stock is currently up a staggering 386% year-to-date, a performance that puts it in the same conversation as high flyers like Tesla stock or Nvidia stock in terms of sheer momentum. Investors who piled in using SoFi Invest or their Fidelity Investments app see a disruptive tech company. But the reality painted by Wall Street analysts is a horror show. The consensus analyst fair value for Opendoor isn't $7.77. It's not even $5. It's hovering around $1.71 per share. This implies the market is valuing the company at over 350% above its fundamental analytical worth. That gap, the chasm between 777 and 171, is the entire story. It is the single greatest tension in this stock, and the November 6th earnings report will be the event that either validates the bulls or proves the bears right in catastrophic fashion. Let's ground ourselves in what we're seeing. The common belief, the narrative that has pulled in so much investment, is that Opendoor is the future of real estate. It's an iBuyer. You go on their site, type in your address, and they give you a cash offer for your home. They buy it, do some light repairs, and then relist it for a small profit. It's supposed to be a high-tech, data-driven algorithm that replaces the messy, slow, traditional agent model. This is what has so many retail traders excited. They see a tech company, not a real estate company. But here is the challenge to that belief, and it's a big one. This business model is almost lethally sensitive to interest rates. Opendoor isn't a software company with high margins. It's a house flipper that uses billions in debt to hold a massive depreciating inventory. When the Federal Reserve hiked rates, the 30-year mortgage rate spiked. Even with its recent dip, that rate is still hovering around 6.2%, which has choked the housing market to a near standstill. This isn't a hypothetical risk. Zillow, a much larger company, tried iBuying and had to shut the entire division down, taking a loss of over $500 million because it could not accurately price homes in a volatile market. Opendoor is the last major player standing, and it's standing in the middle of a hurricane. The stock's recent movement tells you everything you need to know about this disconnect. Just last week, it soared 15% in a single day, not on company news, but because a government CPI report came in slightly cooler than expected. That cooler inflation data sparked hope that the Fed might cut rates sooner. This stock isn't trading on its profits, it's trading as a highly leveraged bet on the Federal Reserve's future decisions. The 5.1% pop on Friday wasn't about fundamentals, it was excitement over the Robinhood earnings stream. This is a meme stock characteristic, amplified by a massive 22.77% short interest. The shorts are betting heavily on a collapse, which in turn provides the fuel for violent short squeezes on any glimmer of good news. It creates a feedback loop that has detached the share price completely from the company's actual performance. Many traders using sophisticated platforms like interactive brokers are playing this volatility, not investing in the long-term business. This isn't a stock you just buy and hold in a diversified Schwab Intelligent Portfolios account. It's a full-contact sport. And while the retail crowd is buzzing, the institutional smart money is telling a very different, very worrying story. If you look at the 13F filings, the data that shows what big funds are doing, the reality is stark. In the last quarter, the total number of institutional funds holding Opendoor decreased by over 8%. The total number of shares held by these institutions dropped by 13.38%. Let's be specific. The Vanguard Real Estate Index Fund, a titan in the space, dumped over 25% of its position. T. Rowe Price cut its position by over 28%. So while traders on the Robinhood app are celebrating a 386% gain and looking forward to the financial open house, the massive managers at Fidelity Investments and T. Rowe Price, the ones with teams of analysts, are quietly walking out the back door. This is the ultimate expectation versus reality conflict. The people who are paid to analyze balance sheets are selling to the people who are watching a live stream. This brings us to the ticking time bomb of the November 6th earnings. The bull narrative rests on the company's last report from Q2 2025. In Q2, Opendoor shocked the market by reporting its first ever quarter of positive adjusted EBITDA, a $23 million profit. Revenue was a strong $1.6 billion. This set the expectation that the turnaround was real, that the algorithms were fixed, and that they had survived the worst of the rate hikes. But here is the terrifying reality. The company's own guidance for the quarter they are about to report, Q3, was disastrous. Management themselves forecasted revenue to collapse from $1.6 billion down to a range of just $800 to $875 million. That is a sequential drop of nearly 50%. And that adjusted EBITDA profit? They guided for a return to losses, projecting an adjusted EBITDA loss between $21 and $28 million. The company has literally told the market to expect a terrible quarter, and yet in that time, the stock has continued to rally. The market has completely ignored management's own dire warnings, choosing instead to focus on the Fed pivot narrative. The entire future of this company now rests on its balance sheet. At the end of Q2, Opendoor was holding $1.5 billion worth of homes in inventory. It was also carrying a significant debt load, reported at $2.3 billion in Q1. The central question for the November 6th call is not just the revenue, but the contribution margin from the homes it did sell. Did they have to liquidate their inventory at a loss just to generate cash flow? We know they are burning cash quickly. If the housing market stays frozen, that $1.5 billion in inventory becomes an anchor that can pull the entire company under. They don't have the luxury of waiting. They have to pay interest on that debt. This is the fundamental flaw in the tech company narrative. NVIDIA stock sells chips with high margins. Opendoor sells houses, a product that costs hundreds of thousands of dollars to hold, requires massive debt, and can lose 10% of its value in a single bad season. So, as we head into this critical earnings week, here is the setup. The bull case is simple. The Fed pivots, interest rates fall, the housing market thaws, and Opendoor, as the last iBuyer standing, captures massive market share. The bear case is just as simple. Interest rates stay high, the housing market remains locked, and Opendoor's $1.5 billion in inventory becomes a catastrophic write-down, triggering a cash burn crisis that its $2.3 billion in debt makes unsurvivable. The company's move to host its earnings on Robinhood is a clear signal they are leaning into the retail investment narrative to support the stock. But that narrative is about to collide with a quarterly report that the company itself has already warned will be painful. This is the expectation. The reality is coming in just in a few days. Comment below with your prediction for the November